Welcome to today's event, where we have the pleasure to present OrderYOYO. Today's event will cover the Q3 report released yesterday, which I kind of think showed continued momentum, highlighted by the fourth guidance upgrade this year, and of course also a sneak peek to the 24 expectations. So I guess that will be some of the discussions we will have today. We are joined today to help us through the presentation, full lineup. We have CEO Jesper Johansen, CFO Jesper Hyveled, and Deputy CEO Mathias Thom. So welcome to all of you. As always, it will be possible to ask questions live at the event. I think we will take the main part of the questions at the end of the presentation. But let's see if someone fits in through between those. Do it in English and do it in Danish. I will try and translate the Danish to the best of my ability. But I think for now, I will hand the call over to you, Jesper.
Yeah, thank you, Michael. Welcome everybody to this presentation of our Q3 9 months 23 report. I'm Jesper Johansen, I'm CEO of OrderYOYO, and I'm here with Jesper Hyveled, our CFO, and Mathias Thom, joining from Germany, our Deputy CEO. So as you said, Michael, strong quarter once again, and guidance raised for the fourth time. So we're proud and happy about the results we're delivering these days. Okay, let's get into it. Next slide, please. Before we start, as usual, just 30 seconds on this important slide. Okay, let's start. Next slide, please, Michael. So, an overview and an important fly into what we do. We liberate restaurants. 90% of the orders of an average independent restaurant comes from recurring customers. The restaurant needs to own these customers, and we help and empower them claiming them back. On top of that, we can do this at much lower cost for the restaurants than the portals, basically cutting the cost for the restaurants in half. This has been our value proposition from day one, and our growth shows that we have a strong product market fit, which the numbers keep on showing us. So Q3 was very strong for us, proving that what we do works, delivering ARR growth of 38% to 256 million for the first time above 250 million. So a big milestone for us. And increasing EBITDA profitability significantly from a loss of 4.1 million in the first 9 months of 22 to a plus of 16.5 million in the first 9 months of 23. So an increase of EBITDA of almost 21 million compared to last year. Especially Q3 was very strong from a profit point of view, 7.5 million, corresponding to an EBITDA margin of 11.5%. And there is no doubt that we, especially in terms of profitability, is ahead of our business plan that we made when we merged OrderYOYO and AppSmart. So strong numbers that we are very proud of. Next slide, please. And next slide. So we are by far the market leader in Europe in our space. This has been a strategic goal from day one. Now, the way we're number one is also important. We go deep in each market, claiming a very strong number one position in the markets we're in. This includes the 2 largest takeaway markets in Europe, UK and Germany. Now, this part of the strategy is very important in relation to profitability. Obviously, being number one means that we're big, that we generate and execute the highest number of orders, highest GMV, and highest ARR. But the way we do it is important because we focus on going deep in each market. The economy of scale really kicks in, as we can see from our profitability. And as I said before, with a margin of 11.5% for Q3 and EBITDA for 9 months increasing by 21 million, we are, as I mentioned before, ahead of our original business plan. This strength then becomes self-enforcing, both in terms of organic growth and profits, but also in terms of acquisitions. A lot of players out there are struggling, and joining forces with us makes sense, both for them and for us. Now, over to Mathias, who'll talk a little bit about our market conditions. So over to you, Mathias, the next slide.
Thank you, Jesper. So let's talk about the current external market conditions, which didn't change much from our last presentation. For our restaurant partners and end users in the UK, the market conditions remain tough, which is driven by inflation and various number of other macroeconomic factors. For Ireland, the situation for restaurant partners is moderate and remains tough for the end users. Denmark, Germany, and Austria will still face for restaurant partners and end users a steady, moderate situation. OrderYOYO proven a resilient and strong performance on all markets with a growth of 31% in GMV in Q3 2023 compared to Q3 of 2022. We continued gaining market shares from both portals and other white label providers and expect to continue to do so. Now I will hand over to Jesper Hyveled, our CFO. Next slide, please.
Thank you, Matthias. And I will, as usual, give you the highlights of our quarterly performance and additionally also the update of our 2023 guidance. So next slide, please. So as already alluded to by both Jesper and Matthias, strong growth on ARR. We grew to 256 million, a growth of 38% year over year. Very strong. And actually, as Jesper also mentioned, the highest ever annual recurring revenue and above 250 million. So very strong. Next slide, please. Our year-to-date net revenue 9 months grew to 181 million, corresponding to a growth rate of 37%. Again, very strong. Do please remember that the 2022 comparison is pro forma due to the merger with AppSmart. Next slide, please. Our September GMV increased by 31%, reaching 2.4 billion. Strong growth, and this in a challenged market, as Matthias alluded to. And when we do compare ourselves with peers, we see that they are not growing or as strong or even dropping in their GMV. So we are taking market shares and something that we are very proud of as well. Next slide, please. Finally, in terms of our Q3 performance, as already mentioned by Jesper, we grew our EBITDA to 16.5 million, very strong compared to a loss in 2022 by 4.1 million. So again, very, very strong. And let's take a little bit closer look into our EBITDA. Next slide, please. So the quarterly EBITDA development, we've been mentioning this for 12 months now. It's a strategic focus for us, profitability. And this is illustrating this very clearly. We have tripled our EBITDA over the last year. Our standalone Q3 EBITDA margin realized 11.5% versus 4% in Q3 2022. And this is, as mentioned in our announcement, a strong focus on profitability, and that has paid off. And we have been cash EBITDA positive in all months of Q3 2023. As a consequence of our current performance, we have, as mentioned in our announcement, also updated our 2023 guidance for the 4th time this year. So next slide, please. And into the numbers on next slide. Thank you. So the annual recurring revenue raised to 260 to 270 million. Our net revenue raised to 230 to 240 million. GMV 2.5 to 2.7 billion. And finally, our EBITDA between 20 and 23 million. So all in all, the strong performance that we've seen in Q3 is paying off, and that's the reason behind our raised guidance here. So a clear consequence of the current run rate. Thank you. This was the final comment from me, and now over to you and our 2024 outlook, Jesper.
Thank you. So next slide, Michael. Yeah, so in this announcement, we provided guidance for 24. We want to give the market the way we look at 24. In general, we expect double-digit growth in both ARR, net revenue, and GMV. So we guide for an ARR of 300 to 310 million, corresponding to a 15% growth. Net revenue of 260 to 270 million, corresponding to a 13% growth compared to 23. And GMV of 2.8 to 3 billion, corresponding to a 12% growth compared to 23. All revenue numbers and growth rates are based on organic growth only, so no acquisition included in these numbers. In terms of profitability, we expect to maintain and expand our cost focus. Economies of scale will also drive profitability in 24. Guide for an EBITDA margin of 9 to 11%, so an EBITDA of between 23 and 28 million. So we are definitely on a strong and profitable growth journey here. You can see that our product market fit is there. Our organization and team is delivering strong results, and we're increasingly seeing the benefits of being number one. So we look forward to the coming quarters and years. That concludes the presentation. So over to you, Michael, and the Q&A session.
Perfect. But there's a lot of questions, so just go into it. It is mentioned there's difficult market condition, but please elaborate a little bit more on what these conditions are and how you have managed to tackle them.
Yeah. Well, I think so. If I start with that, and then Matthias, please pitch in on some of the, especially some of the stuff going on in Germany. But in general, it's basically the same conditions as we've talked about before. So coming out of COVID, which obviously now seemed like a long time ago, two factors happened. So one was that the restaurants did see problems in terms of increased prices, inflation, difficulties to get drivers, fierce competition from portals. So the restaurants are under pressure and are still in these areas, and the end users as well, in terms of especially inflation and the inflationary push that we see now. It has either it has improved a little bit, or people have kind of got used to it over the last 18 months. We do see some sunshine here and there, but in general, it's basically those conditions. And we can actually, I mean, you can see it if you look at some of the portals. So just came with their results, their 9-month results yesterday. So where we grow 31% in GMV, their growth in Northern Ireland, UK, and the northern part of Europe is between 4 and 6%, and actually they're dropping the number of orders. So it's just it's basically just the same. And I think the way we cope with it is a lot to do with product market fit, a lot to do with our value proposition, and a lot to do with the way that our organization performs. I mean, we growth doesn't come by itself, so we are out there chasing it, attacking it, and that works. I mean, anything to add, Matthias, in Germany specifically?
Yeah, I would say it also from a general point of view, we have really the right focus. We know exactly what our target customers and their demands. So we have really tailor-made products which fit the market demand, which also plays into here. There is a continuously improvement of our processes and tools to make our restaurant partners even more successful. And that, as Jesper alluded to, shows also in our order volume and taking the market share. And also our strategies work. We have a very data-driven approach which helps us continuously to improve the performance of our organization and of course of our restaurant partners. And as also Jesper alluded to, growth doesn't come from itself. So it's a grind we do every day, and we're very good at that in executing our strategies and having this strong team behind us, which helps us to achieve this target. That's for me.
Perfect. So no secret sauce, hard work, if I should understand that correctly, and a product market fit that kind of seems to be well presented by or well realized by the growth rate. There's also a question: how have you managed to get your cost reduced? Are certain parts of the organization reduced, or external cost, or development of new software, or something else?
Yeah. Let me start, and then maybe you can join in, Jesper. Obviously, so this is the beauty of growing. So the cost has not been reduced. So we are still investing, but the economies of scale means that we, for the same cost, can actually do more. So we're getting much more efficient. Still investing in all the pockets that we need to do, but because we grow the top line as we do, and we don't grow the costs as much, the EBITDA margin expand as a consequence of that. And then obviously we have, I mean, we're super cost focused, but we're not necessarily and directly cost cutting in general. Yes.
No, just echoing that on the cost cutting. It's not like we are doing restructuring or anything like that. We are basically working smarter and doing more for less, and that is the economy of scale. So one clear example could be various software licenses where we can pool stuff now. Same as we grow in our transaction volumes, we would be able to get better prices, obviously. So that's part of it. And then we are very focused on this. Another consequence of growing is actually that we will have additional costs for various requirements that just increase as you grow. But we are able to take that in without that being impacting our EBITDA margin negatively. So all in all, it's a clear focus, and we don't invest in things we don't believe in. But we if you look at our investment also in R&D, it hasn't stopped. We believe in our product, and we believe that continuous improvement will be the direct source for future growth.
Perfect. Do you have any intent to move to the main stock exchange or initiate the process similar to FOM Technologies or Shape Robotics, which are in that process within the next 12 months?
The short answer is no. I mean, it's obviously something that the board of directors are talking about, once in a while. I think that for us, the ones that have moved, I actually, to be honest, I haven't seen the big effect of moving to the main market. I think that obviously there's been a lot of turmoil around the First North as a marketplace. But for the companies coming from First North to the main market, I haven't seen a big effect, and neither in liquidity or in prices. So I'm not sure that it's something that is valuable. I mean, it's obviously it's news, but for us, it's not something that we're thinking about right now. The way the First North works for us, also in terms of acquiring companies when we do that for shares, works as well as a main market listing does. So it's not something that's in the, we're looking at right now.
No, and isn't it fair to say that, I mean, we have a lot to do with our M&A strategy, and it's that would be a lot of hard work to go to main market. So for me, and I think for the general management here, I would rather spend the resources on acquiring more companies than necessarily go to main market, especially because we don't see the upside when we compare it.
Perfect. There's a question. The EBITDA margin amounted to 11.5 in this Q3, but you're guiding for an EBITDA margin of 9 to 11 for 2024. Do you expect margins to decrease? And if yes, why is that?
Good question, and well spotted. Well, I mean, obviously Q3 was, from a profitability point of view, very strong. So if you look at the guidance for the full year of 2022, we guide for an EBITDA margin of between 8 and 10% for the full year, and we guide for 9 to 11% for the full year of 2024. I mean, there is some seasonality in this, but obviously we have seen a strong Q3. But it's a fair question, and it's one of those where we want to basically see these trends and improved EBITDA margins materialize before we kind of raise even further.
And just one thing to add here is also a little bit in regards of timing and cost here, because we do expect investments in Q4 on the employee side, bringing us strongly into 24, but there is no guarantees, obviously, that we will be able to hire as planned. So the margin might become better, but according to our plan, we will invest in Q4. So that's a result of those investments.
And I think you gave a question here, because how would you describe the outlook? I'm jumping a little bit around so it fits. How do you describe the outlook guidance? Is it optimistic, moderate, or conservative? I'm guessing both the 23 and the 24. So if you could give your feeling on how you think of the guidance.
No, that's a fair question. If you look at, let's start with 24. I mean, we would probably define that as conservative. Going into a year with nothing in kind of in the book already by either through a Q1 or Q2 or whatever. So we are on the conservative side there. I would say on the 23 guidance, it's moderate, or in the sense that we are 9 months into into the year. So net revenue is 181 million in the 9 months of 23. So we are much closer to where we'll end in terms of the and much, you know, the way that we can look at this, we have much more clarity on the 23 numbers, right, than we have on the 24. So they will probably be defined as, you know, moderate, or, you know, what we expect, I would say.
Yeah, because there is this question also about your Q4. Normally you show higher results in Q4, and I guess the season for takeouts is, I guess, also a little bit higher this season. So there's a question here saying that historically you have been showing a stronger revenue and EBITDA in Q4, and if that were to happen, the historical, then you would actually exceed your guidance. So the question is, are you seeing anything issue that is not making you guide higher than you already are?
We don't see any issues. So in that sense, you could say that our Q4 guidance is conservative, that specifically, and well spotted.
Yeah, and just so as you alluded to, Michael, there are two parameters here. The net revenue, obviously, but do remember that 50% of this is transaction driven. So we need to see that the market develops as usual.
The question here was that whether we saw anything, and we don't see any issues.
No, we don't see any issues.
Okay.
No. But yeah, it because you have the transaction part, you always are a little bit less hesitant. It makes sense. Then there was also a question here if we should go to the 24 guidance. What market growth expectation is behind the 24 guidance? You know, I know it's fragmented market and market growth, but
the market growth.
What are you guiding to reach yours? Is that also still taking a market share, or is a flat market in 24? So what do you have in those your guidance?
I think that the general market for 24, we expect more or less unchanged market conditions compared to where we are now. So I wouldn't be surprised if we 12 months from now will sit here and say that the portals have been growing, you know, between 0 and 5% again, which are kind of the best proxy for the total market, right? For takeaway. So I think that the general market growth around 5%-ish makes sense. I'm looking at Jesper and he's nodding. So that's kind of the market condition, and then we expect that we will continue taking market share, and then obviously, and I do see that we're guiding for a 15% ARR growth, and we are growing at 38% now. So we also see the big difference in these two numbers. But and this is where I say that we if you want to kind of. So what bucket are we in terms of conservative, moderate, optimistic? We're in the conservative space here, but we do think that the market still will be challenged in 24.
Perfect. And then, as the market leader, how does competitors react to you taking market share? Or so some of is there competitors out there reacting to you taking market share? I guess you both elaborate that you take it from food portals, but also from other white labeling competitors that you have. So how are they reacting to this one?
Yeah. So you could say, so let's take the portal first. I mean, and I think here that you have to remember that if you look at the portals, start by looking at the total addressable market here. So how much takeaway is actually eaten, you know, on a yearly basis. Even though that we're the biggest in Europe on this specific market space, we are only just a fraction of the portals. So the portals is, in my book, doing something else. They're fighting against each other, and they're fighting on delivery. So that's where their battle is going on. So it's not like we have actually seen before. So if you go 3-4 years back, we did see some push from the portals towards us. I think that they are focused much more on each other and on the delivery side of the business than earlier. Number one. Number two, I think that the portals are opening up, as you see it in the US, with DoorDash and Uber Eats opening up to also to the white label spaces, so that you can actually use their delivery systems as part of your offering, we will start seeing that in Europe as well, I think. So that's kind of one part. We don't see a specific competition coming from that. From the other white labels, yes, we do see in different markets, and there are a lot of different players, and obviously we know a lot of these because we are calling them and talking to them, on a regular basis, because some of them we want to acquire, and some of them we just, we're just talking to them. And yes, we do see competition. We end up in the receiving end more than on the delivery end in terms of taking market share from these, mainly because of our product offering. Everybody else, more or less, is actually, I think, selling very much on price. And everybody that we look at, maybe besides from a few, do have problems in terms of scalability. So of 500, 700, 1,000 restaurants is difficult, and that's what we can do, doing this at scale. So yeah, we do see competition for white labels, but we on a net basis we take more than we give away.
Is the market too fragmented to really you see a push if you because you must be taking a lot of market share? Is that also an explanation that the market are pretty fragmented beside your size? So it's hard to see a real pushback on you.
Yeah, beside us, it's very fragmented, and we actually, so we've talked about M&A and all that stuff before, and we're looking very intensely into this. We actually also see a lot of companies in our space going bankrupt these days. So there's also, other white label providers just going out of business. We saw it here in Denmark with Quick Order, We Order, so Danish Norwegian company that went bankrupt in the summer. We've seen it in Switzerland, we've seen it in the UK, and in Germany. So no doubt that the market is under pressure. Anything to add, guys? Matthias?
No, I agree 100%, yes.
Then there's a follow-up question to the market share. How is churn turning out for you? Because it kind of looked, you haven't given in this report, the Q2 report, but it looked kind of, when we looked in your half year, that churn was improving. So any small details? I know you can't give a number, but
no, but MRR churn is improving still, and yeah, it's obviously a focus area, but is improving compared to second half of 22 and first half of 23. Yeah.
And then to round it up, maybe a little bit, and maybe we should have started by that, but there's a question whether you can give us some of the abbreviation, what they stands for. Maybe we should take the GMV, the ARR, and the cash adjusted EBITDA, because I think that's a little bit special for your type of business. So can you give some explanation to maybe if a new watcher is watching into your type of business of the GMV, the ARR, and the cash adjusted EBITDA? I think that's a little bit special for you guys.
Yes, sure. Okay, I will do so. So the GMV is basically everything that runs through our platform in regards of the restaurant's revenue. So basically the full transaction value running through our portal, shop or web shop or app running through via the restaurants. So total revenue running through our system, not with anything external from our POS. It's solely our shop system. Our ARR, so annual recurring revenue, it's the revenue, the accruing revenue for the month reported, in this case September, and in the guidance case December, times 12. And that's why you will see a difference between our ARR and our net revenue. Basically, the ARR is corresponding to a current run rate in our annual recurring revenue. Now, what's not on this slide is the cash EBITDA. So our cash EBITDA is defined as our normalized EBITDA, which we guide upon. So the 20 to 23 million here. and then adjusted for investment in R&D, so capitalized R&D expenses. And that's very important because that is showing if we are able to, from an operating point of view, generate cash. So it's basically our operating cash flows, and it's a key parameter for us that we want to be self-funding on from a cash point of view, and that's why it's such an important milestone for us. I don't know if that's answering your question, Mike.
Yeah, I think it was, it's just if someone looking in for the first time, the GMV, the gross merchant value might be at least a new vocabulary. Perfect. The last questions, and I will let you guys go. Which regions are driving the biggest growth?
We actually see growth both in South and North. So both Germany, UK, Ireland, and Denmark. Now, to rank them, the highest growth or we probably see a somewhat higher growth in Germany. Ireland is strong. Then UK, and then Denmark is probably the one with the lowest growth, as we have the highest kind of maturity in this market.
Perfect. I don't have any follow-up questions from the audience. So if you want to round it up, or else we can just leave the call. So I don't know. Do you have any roundup, Jesper? Or?
No, that's just as I said about the guidance. I think that we for 24 we're really looking forward to the last quarter of 23 and going into 24. So you could say that the merger between AppSmart and OrderYOYO that we did more than a year ago now was transformational in the sense that we actually generated a full-blown growth company that is profitable, and we continue to see that we can deliver on that. So super excited about the opportunities. As Matthias said, it's grinding every day, but we're good at it, and we'll just keep on doing that. So yeah.
I think we will let that be the end. Jesper, thank you to you, Jesper, and thank you to you, Matthias, also for joining in, and thank you for the audience listening in and getting us around very well in the case with a lot of questions. So may everybody have a nice day.
Same to you. Thank you.
Thank you.
Bye.
Thank you. Same. Bye.